IBM. So I'll let him just introduce himself and talk about, what he works on.
Do you need this? Hey, good morning, everybody. Good morning. Good to see you. Well, I know there's, this is like, I was talking to some folks in the back, and usually I'm up presenting, in some marble room to a bunch of people with frowns on their faces that aren't buying what I'm saying. This is more like preaching at the Church of True Believers this morning. And you're out here on a Saturday too, so that's good. That's good. So, well, thanks for coming and giving me your attention for a little while. My name is Jesse Lund. I run the solutions portfolio for blockchain and financial services for IBM. And primarily we're focused on developing use cases that will really transform the landscape of banking and investment banking and capital markets. So I apologize up front. I gotta do a little bit of a commercial for the company that I work for, and then I'll tell you what I really think. So IBM, if you haven't heard, is betting the company on blockchain, along with a few other things, including cloud and cognitive and AI. And we have over 1,000 people across the world in more than 160 countries doing work on more than 400 different blockchain-related projects. So just a few of some of the names and the industries and the sectors that we're working in right now. There is a ton of stuff going on, and IBM is the place to be if you want to be in a big company and you want to focus on the application of blockchain across the world. I joined IBM about just a little over a year ago. The draw for me, and I'll let you guess where I came from before, but the draw for me was there was really no other company on the landscape that had the breadth of capability. I mean, think about an entity like IBM Research, with thousands of really, really smart people, a portfolio of over 75,000 patents, to be able to draw on. The presence in more than 160 countries, the service delivery capability and the credibility, the technology, the focus on blockchain and Hyperledger, which is a consortium under the Linux Foundation, the fastest growing project ever under the Linux Foundation that IBM is a kind of a key sponsor, a key part of. So the breadth of capabilities is just fantastic. And so I joined IBM. I quit a really good job at a decent sized bank up the road from here. I'll let you guess who that was. And I did a whole bunch of jobs for them. I worked at Wells Fargo for 18 years, and I moved around from retail banking to community banking. I worked in IT for a while, and the last part of my tenure for about the last 3 years was running a group they called the Enterprise Innovation Lab. And so I managed a portion of the research and development dollars that Wells Fargo pours into new and emerging technologies to stay up to speed, to not be this old, stodgy, kind of institution, but to become more innovative. But for me, it wasn't really enough. Some of the things that we're working on in banking were what I would consider to be in an emergent area like blockchain or cryptocurrencies, kind of table stakes. So some of the things that we were working on. If you know the banking space, one of the innovative initiatives in banking and in payments is something called faster payments, as an example. Faster payments is essentially taking the automated clearinghouse batch process that runs once a day and run it like 3 times a day instead. So not exactly transformational innovation. And there's a few other things going on in that space, but it just, for me, it just wasn't moving fast enough. It wasn't transformational enough. It was innovative, it was incremental, but it wasn't really truly transformational. And one of the things that I loved when I was at Wells Fargo in this innovation group and running the lab was this diagram. This is probably an older version. You can go get it. CB Insights puts this out. But we used to love looking at this because what they did is they essentially took Wells Fargo's webpage and they showed every area where Wells Fargo was being killed, death by 1,000 cuts, right? And all of these different places where startups and fintechs were attacking just portions of Wells Fargo's portfolio, almost impossible to fend off, even with a lot of really smart people and a good-sized R&D budget, because the focus was on how do we incrementally improve the systems that we already have, as opposed to how do we start over. And so the focus was really how do we change the world? And so I remind my bosses, the executive team at IBM, that I left a really good job at a really good company to work for IBM because I want to change the world with blockchain. I want to change the face of how banking and capital markets works with blockchain, and I think it's absolutely, totally possible. So, sorry, trying to get this thing to work here. There we go. So there's a great quote that I tried to find I want to attribute it to somebody, but I can't find who said it. But I love this quote that really captures the spirit of the potential for blockchain and distributed ledger technology and cryptocurrencies. No amount of innovation to the propeller gets you to the jet engine. What we're doing here, what you're all involved in, is truly a paradigm shift. And it applies to a bunch of different industries. My industry just happens to be banking and capital markets. And there was nothing really happening in financial services that was truly transformational until Bitcoin came along. How many of you are Bitcoin investors? I hate to use that term. Wow, that's good. So I've asked that question at central banks. I've been to 20 central banks around the world in the last year. I was at the Bank of England meeting last week with the head of digital currencies, and I had to do the same thing. How many of you guys own Bitcoin? No hands went up. I don't believe them, actually. So Bitcoin did a beautiful or a wonderful and at the same time a terrible thing to the world. The beautiful thing that Bitcoin did is demonstrated that money can move as easily, as frictionlessly, as we say in the industry, as email can move, as information can move. So it's really the disruption of the internet that's already hit other industries like retail is now really coming to the banking space. Now here's the truth about Bitcoin, and some of this is language for the initiated, but it's easy to understand. Bitcoin is a global, autonomous, real-time gross settlement system. What that means is that you can send money, and by the way, I'm a Bitcoin investor too, but I'm not a huge advocate for Bitcoin per se, but for what it stands for. You can move money to anywhere in the world, to any person, relatively real time, with very small fees. And if you know what you're doing, you can almost pay no fees. And that's transportable across virtually any currency, at least all the world's major currencies. That actually is a profound capability. It's a profound capability in today's world, where banks. I was just talking to Hector. Where's Hector? There he is. I just met Hector this morning. He was talking about remittances and sending money back to his family or to family members in Mexico. On a $100 payment back to Mexico, they'll charge you $25. Now, I don't work for a bank anymore, so I can say this. That sounds like robbery to me. So this is going to change a lot of that. So what was the bank's reaction to Bitcoin? Well, we all know Jamie Dimon. I like to pick on Jamie because, he made some public statements early on about Bitcoin, but the bottom line is that, this isn't really that important. This is from 2016. You look earlier this year, now Bank of America, not JP Morgan, but Bank of America came out in an article and said, you know what, actually this cryptocurrency thing might actually be a threat to our business. And it's kind of like, where have you guys been? So it's really interesting to see what's happening. Now, this notion of skepticism in banking isn't the first. It's not the first time that this has happened. If you are a history buff, if you like American history, and you'll love the irony in this and what the Federal Reserve does if you don't know the story of what the Fed did. is that if you go back and you look at the history of our presidency in the 1800s, Andrew Jackson hated paper money. He hated paper money as much as bankers today hate digital money or cryptocurrency. In fact, he waged a war against a previous version of the Federal Reserve. It was the only federally chartered bank in the United States, and he was actually successful in shutting them down. But he waged this war. He wanted to make sure that only coinage minted in precious metals were legal tender. So there was huge distrust of central banking back then. So what we've come to accept as just reality in paper money, which all they are is really just, they're just promissory notes. That's all they are, that the government will actually pay you out some value in exchange for this piece of paper. That was actually a big transition for what we just rely on now as the norm, right, of cash. So I think it's ironic that for the last 100 years or so, Andrew Jackson's face is on the $10 bill. I think that's just funny. So the Fed obviously has a sense of humor by putting his face on paper money because he hated it. So what's happened is some of the banks have changed their tune a little bit, and they've come up with this term that I don't like it very much, to be honest. I feel like it's a little bit too cliche, and that is, well, we don't really like this Bitcoin or cryptocurrency thing, but we really like blockchain, right? Which, and of course, if you've read the primer for Bitcoin from 2009, I mean, blockchain is Bitcoin terminology. That's where it came from. It came out of the Bitcoin primer. But to say that you don't like Bitcoin but you like blockchain, I think is a little bit ambiguous, and here's why. Blockchain provides a number of capabilities that I think are valuable. These things like shared immutable data. What that means is that you write data once onto a shared ledger and you can't change it. Nobody can change it, right? So you can rely on the accuracy of that data. That's valuable. And it's a peer-to-peer network kind of architecture. So there's this distributed computing scalability model that anybody in the world can kind of participate on this if you can get on the internet. That's fantastic. And then trust and consensus. You don't have to trust people in order to participate on this network. You don't have to know everybody to participate, to trust. So these are valuable things that blockchain brings, but they're also things that conventional technologies today, like centralized databases, messaging systems, storage platforms that are certified to write once and read many times, these capabilities are already built into the IT infrastructure of most banks today, which is why there's still very few production systems at banks that are using blockchain today. So it's a long curve to get there, but what they're missing is the thing that Bitcoin actually provides, which is why I don't like the cliche, right? I like Bitcoin or blockchain, but I don't like Bitcoin or cryptos. What they're missing is this ability to actually closely couple the store of monetary value and the ability to transfer that value as easily as you can move the data around that's associated with that value. That is what makes, I think, blockchain, and by extension to that, cryptos, enormously transformational. So to take that out is to actually lose a huge part of the value proposition of why you would apply blockchain in the first place. And so what it really comes down to in some ways is this notion of public or private networks. Now there's places for both, and let me just explain really briefly what I mean by that. So if you followed IBM and some of their progress in Bitcoin, or in blockchain, we're not involved in Bitcoin at all. In fact, we don't see value in the mining kind of process. It's grossly inefficient. We've invested a lot in Hyperledger, the Hyperledger project, and in particular two technologies or two blockchain protocols within Hyperledger. One is called Hyperledger Fabric, and it's purpose-built for creating trusted private networks. You can go actually create your own network, create your own rules, pick your participants, and build your own global distributed ledger network. And it's great. And we've announced partnerships with some big names like Maersk, right, where we're digitizing the exchange of data for global trade. All of these containers that move around the world. There's a lot of paperwork, and there's a lot of cost that goes into managing all that paperwork, and we can put all that on the blockchain. Same with Walmart. There's an initiative called Food Trust, which is a food safety supply chain management thing where you can actually follow an item, a strawberry, for example, from farm, from the plant, all the way through to the shelf on the store. And we can track the provenance and the time of that, so we can actually know, is this thing safe to eat or not? And believe it or not, that's a really big problem, right? So we create these small private networks that then can grow because there's a network operator. In the case of global trade, it's Maersk, the big global shipper. In the case of Food Trust, it's Walmart, and IBM is facilitating the management of that network. The other protocol that we've invested in is a public protocol. It's one called Stellar. And Stellar is a public minerless distributed ledger technology. Some of you who are crypto fans might know Stellar by association to its native asset, which is called Lumens. We are not, IBM is not a holder of Lumens or any cryptocurrency at this point in time, because IBM, being a 108-year-old company, is still trying to understand where the regulators are going and how they're classifying cryptos. So we're not against cryptos. We just need to work with the regulating agencies to make sure that if we're building solutions that use cryptocurrencies, that we understand the implications of that. And IBM doesn't want to all of a sudden overnight become a regulated money service business. So we have to take care in how we get into that. But we are building and did launch and announced last October a cross-border payment solution that Hector would facilitate the timely and cost-effective transfer of money. And so you'll be hearing more about that in the coming months as we kind of launch that out to the world. That'll be running on Stellar, which is part of the Hyperledger project, and it will actually be using Lumens as a bridge currency, but also support for other digital assets. So anyway, so it comes down to kind of this notion of public versus private networks, I think, and the jury's still out as to which one will win. Personally, I think there's going to be an intersection of both. So if you have a whole bunch of different private networks, ultimately, they're going to want to talk to each other. And so inter-network or inter-ledger communications is going to be key, so keep an eye on that. But my take, having been an ex-banker, is that there's plenty of gain to go around. So if you're a bank and you're thinking, oh, if I get onto this public kind of network, this is going to be out in the wild, my fees are going to be exposed. Banks make a lot of money on for example, cross-border payments and foreign exchange. They charge a lot. But what I think we're overlooking is that right now, there's over 2.5 billion adults in the world who don't have access to financial services, who actually don't have access to a bank account, which I think is profound. And yet, in these developing countries, primarily Africa and India, they all, at least 1 billion of them, have feature phones or smartphones. So they have the capacity to hold and to transact with digital money just in their back pocket. So there's a huge untapped, unserved, or underserved market out there that banks could tap into. There's also, in the global trade, if you go look at the World Trade Organization, there's over $8 trillion every year of non-bank intermediated trade flow. So when Toyota or General Motors buys supplies from a supplier, a tire manufacturer in another country, they use a bank to facilitate these big purchases and to finance their receivables or their payables, right? It's a big business. And these letters of credit are expensive. Banks make good money on this. But there's $8 trillion worth of trade outside of that is not intermediated by any bank. So I went to school at Pepperdine a long time ago, and we used to hang out at this place called Gladstone's, and they did a lot of, I think they did like $1 million a month in alcohol sales. And so I was used to marvel at the little push-up umbrellas and how many of those little push-up umbrellas and drinks that Gladstone's would put out. Well, they're buying those from a Chinese supplier, and they're buying them in big bulk, but they're not using a bank to facilitate that. So the way that works, it's called open account trade. The way that works is they issue an order, And the supplier either says, well, I've sold to these guys before, so I'm going to ship this order, and I'm just going to hope that they pay me, right? Well, the distributed ledger blockchain, and especially these open payment networks, these cross-border payment networks, can really facilitate the addition of trust. And banks could get involved in it. It's a market they're not touching today because these smaller transactions don't have enough range, they don't have enough value to really provide the profit incentive according to their current model. So I think there's a lot of benefit there. So this is a conference on the state of digital money. Most money is digital. My former boss at Wells Fargo and I used to debate this all the time. He'd say, Jesse, most financial instruments are digital today. And he's right. But the problem with them is, like if you think about stocks, for example, equities, they are digital. I mean, you don't hold a stock certificate anymore. You can get one, but usually you order one and they have to print it up for you. They're held in trust by a depository company, a custodian that will hold these securities. That network and the database that they have is not interoperable with the trading exchanges. So what happens is, and this blows my mind when you think about the trillions of dollars a day that move through our capital markets, is that when you place a trade, when you buy a stock, when you buy IBM or Wells Fargo, that trade transaction happens, but it doesn't actually settle for 2 days. Right? So the transfer of the ownership of the equity that you bought doesn't actually get moved into your name for 2 days because there's this coordination between the counterparties on both ends of the trade. And now these things move pretty efficiently, but for me it's just, it's profound to think that you got one digital asset, in terms of the security, and you've got cash that you're paying with out of your money market account, and these things aren't interoperable on the same network. It blows my mind. And there's no technology barriers to making that happen. So I think there's several things that that will guide the future of digital money in a more interoperable sense. And I've listed 4 here. And the first one is to be able to store and prove your ownership of value and to be able to transmit that value. And Bitcoin solved the first one for us. That problem is solved. Bitcoin determined how to convert electricity into a store of value. That's effectively what it did. Now, Bitcoin, I like to say, is kind of the analogy is it's the rocket that got us into the space race, that got us into orbit, but it's not the ship that's going to take us the journey to Mars and to beyond. We're going to build new networks to do that. That's not going to mean that Bitcoin's going to go away. It's going to be useful for a lot of things, and it is useful for a lot of things, and there's a lot of investment, as you've seen. I think Goldman just 2 days ago announced some additional products that they're building on top of the Bitcoin network. But to store, possess, and transmit value, that's here today. And that's the beautiful thing that Bitcoin did to the world, because they didn't just propose a concept. They proposed a concept that turned into an open source project that has now turned into an entire social movement that is transforming financial services. The second one is the ability to digitally represent, oops, that was a big jump. Second one is the ability to digitally represent different types of assets. So this is what I call this emergent token economy that's happening right now. You've all heard of ICOs, right? Initial coin offerings, which is kind of the tokenized version of securities. It's really transforming the whole crowdsourcing model, and it's actually starting to transform and disrupt the whole investment banking model. And the SEC is now getting really interested in this. It's kind of interesting. People say, oh, there's like 1,500 cryptocurrencies out there. That's not really true. There's like dozens of cryptocurrencies, right, that are reflective, that are digital assets that are reflective of cash instruments. And there's like 1,000 or 1,200 ICOs, coins that trade in a similar fashion, but represent actual secured interest in companies, securities, right? And so this new token economy is going to enable the creation and the digitization of all sorts of asset classes that will live on the same network, or at least will live on networks that are interoperable, so that problem I explained when you buy and sell a stock, that'll just go away. The transfer of value and the transfer of ownership of the asset will just happen in real time together. And that's kind of how it should be, because there's no technology barriers that are preventing that. What's happening now is there are intermediaries that are preventing that. So IBM's got IBM's a machine of PR. I've come to learn in the last year. They have amazing amounts of resource, but I co-authored a paper that you can go download online called Programmable Money. I wrote it with Jed McCaleb, who's the founder of Stellar and former founder of Ripple. We're in the process of writing another one on the token economy. It'll be out next week. And these are just kind of points of view that I would encourage you to go check out. But I think the emergent token economy is something that is really going to be kind of the tipping point for how the paradigm shift starts to happen. And of course, the ultimate digital token would be, or is, a central bank issued digital currency. So I've been, like I said, to like 20 central banks in the last year, all around the world. And we're actively working with them to issue a token that represents a claim of real cash deposits held at the central bank. This is going to happen, folks. It's going to happen soon. And if you want to read a piece of work that's very inspiring, go to Riksbank. They are the central bank of Sweden. I was there about 3 weeks ago. They have a very inspiring white paper about how to get to a cashless society. So there's no more checks in Sweden. I don't know if you know that, but there are no more checks. You can't write checks in Sweden. They don't do that anymore. And they're trying to get to a cashless, a purely cashless society. But if you want to read about their vision, they have a paper. You can go download it for free. It's in Danish and English, so I recommend the English version. But it's called E-Krona is the name of the paper. So if you Google it, it might come up with the other version. Search for the English version, read it. It's inspiring. Central Bank of Sweden is the oldest central bank in the world and the fourth oldest continuously operating bank in the world. This year is their 350th anniversary. So these guys, they know what they're doing, like a lot of central banks do, and they have an amazingly inspiring view of this. The reason they're not doing it tomorrow with us is because each country's a little bit differently, it works a little bit differently, and in Sweden, their legislature, their version of our Congress, has to vote on the issuance of a new denomination of the currency versus some of the Asian central banks that have the autonomy to do that on their own. But this is coming. I mean, this is coming in a matter of a couple of years. Now, I show you this. Did you guys know there was a $100,000 bill? Did you know that? There is. It's not in circulation. It never actually was. When I was a kid, I can remember looking up in the encyclopedia. That shows you how old I am. What's an encyclopedia? I remember looking up a picture in an encyclopedia of a $100,000 bill. And the reason that the US minted $100,000 bills was as a large denomination bearer instrument that would allow banks to settle funds between each other, right? So you just physically pick up a stack of $100,000 bills and you move it from one bank vault to another, and you've now settled whatever intraday debt or obligation that banks owe each other. So if you're a Wells Fargo customer, the chances are you're either a Wells Fargo customer or a B of A customer, because between the two of them, they bank like 95% of California. And what happens when you pay your bills every day, at the end of the day, Bank of America and Wells Fargo net up the flow of funds between your vendors, your utility company, your cell phone company or whatever, and they have bank accounts at the other one, so they net them up, and at the end of each day, Wells Fargo owes Bank of America $200 million, and then the next day, Wells Fargo or Bank of America owes Wells Fargo $150 million, and so they have to settle every day. And the old
from a banking standpoint, also from a regulatory standpoint, one of the biggest concerns is the transfer of funds illegally, money laundering, things like that. So how is this technology able to monitor that, control that in a decentralized type of environment?
Yeah, so that's a great question. When I said Bitcoin did a beautiful and terrible thing. The terrible thing is that it gives you the impression that banks are no longer needed. That's not the case. And we talked a little earlier about banks providing a lending function, but banks also provide as a compliance function. The function of knowing the customer that they're dealing with, right? Identifying accurately who you're dealing with and monitoring transactions so you know there's not any nefarious activities going on. I think banks will continue to play that role. So in this decentralized network, like the one I talked about that IBM has been building and has prototyped and will be launching here soon, we still rely on regulated entities at both ends, what we call kind of the first and last mile, right? Where the money hits the system and where the money is taken out of the system. Those regulated entities, we're leaning on the regulatory bodies of their jurisdictions to ensure that know your customer, KYC, and AML and transaction monitoring are still happening, right? We're not just going to go sign up pawn shops to this network and you can just go and withdraw money or deposit money, because that would facilitate money laundering and all sorts of nefarious activities. But I will say this. Digital currencies are infinitely more traceable than cash. So cash is actually a problem, which is why Sweden's trying to go. It's a different problem for them, but cash is not as traceable as digital currency. Now, who owns the account, the wallet, that's a different problem. And like we were saying earlier, that's up to the CIA and the FBI to figure out. That's not our problem. But you can follow the money a lot easier on a blockchain when you can follow cash around the world.
Hi, thank you. So we didn't really speak much about smart contracts. Where do you see smart contracts fitting in, and what is IBM doing in that regard?
Yeah, so within the private, I talked about two network architectures or topologies, if you will, private and public. The Hyperledger Fabric networking protocol, distributed ledger, does actually support smart contracts. So we do support that. The Stellar network, the public network, is more of an asset registry, kind of a high-performance minorless asset and exchange registry. So there is a place for contracts, but there's also a really big debate right now about whether contractual language should be written by lawyers or should be written by programmers. So that's just a debate that's happening out there, right? So when you put a smart contract out on Ethereum, for example, you're defining, especially in the context of issuing, like a coin that represents security interest in some company that you might be starting up, you're actually potentially supplanting a legal document, a paper document that normally everybody would sign, with an immutable contract that just sits on the ledger that says, hey, if you buy this, you're agreeing to that. And so there's a debate as to whether programmers should be writing legal contracts or lawyers should be writing legal contracts. So we support both. There's also a lot of regulation that's going into this. So smart contracts are going to have to change a lot as these types of things become more and more regulated. So I think there's a place for them, absolutely. There are some other technical debates about the attack, the cyber threat, the attack surface, that having a Turing-complete programming language on chain when it's coupled with value. So you've seen on Ethereum a few exploits, the DAO, for example, and if you find or can exploit the code, you can actually take money. And the way that digital currencies work is once it's lost, right? You can't recover it. So there's a technical debate. Personally, I think we shouldn't be worried about the attack surface, because we can fix that. We can plug those security holes. The technology will mature over time. So I think there's a place for both. But you're right, I didn't talk too much about it. All good? All right, thanks everyone.
Congratulations, everybody.